like to tell you more about our very special speaker, Susan HayesCulleton. Susan is the Managing Director of HayesCulleton Limited, author of The Savvy Guide to Making More Money. She's also a very successful individual trader, financial trainer, and speaker, including TED Talk. I'm delighted to now introduce you to Susan. Hello, Susan.
Thank you so much indeed for that wonderful introduction, Emma, and indeed to everybody who has joined us from, as you quite rightly say, all over the globe. Today what I'm going to do is take a look at the APAC region, and I'm going to take a look at it in the context of a webinar that we gave a couple of months ago. Actually, it was in early April when we looked at the first quarter. We're now, of course, just after finishing the second quarter, and indeed Morgan McKinley and I are partnering up to deliver the Q3 and Q4 outlooks also. So for those of you who joined us from Q1, this will be an update. For those of you who are new today, well, of course, this will give you a starting point at which to look at the economy, and of course, please do tune in with us again for Q3 and Q4 later on in the year. So there's 5 areas that I'm going to take a look at today. We're going to first of all examine Japan. We're also going to take a look at Hong Kong, Singapore, China, and of course Australia. So there is lots and lots of geographical area to cover in those groups, but it is important to look at each one individually as they all have their own individual personality as well as economy. So if we start here with Japan, the name of the game in Japan is creating inflation, and Abe and his Abe economics are really doing all they can to create inflation. The main thing that I was speaking about when we were talking about Q1, as I mentioned in April, was the consumption tax. There was a consumption tax which was created in Japan with a view to bringing forward consumption, which it generally did, because if you thought that goods were going to get more expensive next month as opposed to this month, well then of course you'd buy your goods this month. So it brought forward a lot of consumption, which of course was good for retailers, and it created artificial inflation because prices were now higher. This generated revenue for the government and gave grounds to employees to look for wage increases. And that was, all of that happened, and that was all a good idea at the time, and that would have created a once-off stimulus to give money to the poorer members of Japanese society. So what has happened since? Well, naturally enough, expenditure or retail expenditure has since fallen because, of course, if you're bringing forward expenditure, then there's less to take place afterwards. However, the point of the exercise was to create wage inflation, and that is not happening at the level that it needs to keep up with what is going on with Abe economics. And particularly this statistic stands out to me, and that is that total household incomes fell by 7.1% in April relative to the year before, after adjusting for rises in prices. And this is the biggest fall on record. Now, by the way, this was April, which meant this was before the consumption tax. So what this means is that if it costs, let's say, 1,000 yen to buy a basket of shopping, well, this time last year, you could actually buy 7.1% more with that 1,000 yen. So what that's telling you is that your purchasing power of the Japanese household has fallen. So what that means is that, yes, inflation is happening, but the wage increases and the ability to keep up with those increases is not happening in the household. Now, what that leads to is, of course, decreased expenditure, because if you can't spend as much, well, then you're simply not going to. So as a result of that, and this brings us back full circle, is that inflation expectations are in fact falling to between 1.5% and 1.7%. So that's telling us that the expectations of the Japanese population is falling, because if they can't continue to buy goods at their previous level, never mind buy more, well then the rise in price is going to have to fall. And that is with Abe and his central bank throwing everything that they have got, bar the kitchen sink, at creating inflation. And this brings me to the chart in front of you there. So what you see is that CPI is, of course, Consumer Price Index, and that is a measure of inflation. Now the red line is the CPI for Tokyo, and as you can see that is at a level of 3% higher than 2010, which is, of course, the objective is to create inflation. And that would be at a level, now as I say, that's 3% since 2010, because you can see there that the baseline was 2010. So that is going in the right direction for Abe's ambitions. However, let's look at the inflation level, okay, which is CPI, Consumer Price Index, and exclude the tax increase. So let's take out the tax increase, the consumption tax, and look what you see. Inflation isn't budging, and this is the problem. So what does this mean? Well, it means two things. One is that what has been done in the past is not enough. Not enough to create the inflation of 2% at that particular level. But on the other hand, what it's also saying is that there may now be more room for central bank activity. And yes, it's artificial. And yes, you would prefer if the market was doing it on its own. But as an employer, as an employee, as an investor, as a business person, as a typical householder in Japan, that may mean that there is further help coming down the line from the perspective of the Japanese authorities. Now, there's a plethora of other things that I could talk about today. I could talk about the weakness of the yen. I could talk about the increase in energy pricing. I could look at confidence. I could look at manufacturing assessments. I could look at capital expenditure. There's many different things I could look at. But time constrains me, and as a result of that, I would just say we will be looking at this economy over and over again with Morgan McKinley, so stay tuned. But inflation and trying to rise it is the name of the game in Japan. Now, if we move on from there and we take a look then at Hong Kong, what I was talking about at the Q1 webinar was very, very clear, and there was the big story in Hong Kong was one thing only, and that was that the fact that the Hong Kong Stock Exchange was now open to Chinese investors. Now, let's think about what that means. If the Hong Kong Stock Exchange is open to Chinese investors, that means that you've got a big new source of demand in town for Hong Kong companies that trade in the stock exchange. Now that creates an opportunity for Hong Kong companies because the cost of capital decreases if you've got a higher demand. Naturally, that's one of the most simple laws of economics, is that if you see if you see more people coming on board and looking for your product, then the price of it may naturally fall if the supply is constrained. Now, let's just move on past the economic theory here and just think about something very practical. If you have more people demanding Hong Kong companies, what do Hong Kong companies on the Hong Kong Stock Exchange trade in? Well, you might say that's a very obvious question, Susan. It is the Hong Kong dollar. Exactly. So what happens to the Hong Kong dollar if a lot more people are going to demand it? Well, the price of the Hong Kong dollar is going to rise. Which brings me to the big story of Q2 2014, and that is that the Hong Kong Monetary Authority stepped in for the first time since 2012 to defend the 30-year Hong Kong dollar peg, and they bought $2.1 billion, which is at the upper end of the convertibility range. So that's telling us that one of the laws of unintended consequences may perhaps have been, yes, of course, to lower the cost of equity funding on the part of the Hong Kong companies, but of course then this had a ripple effect on the currency, which has a ripple effect on everybody. Because let's think about it. If you're an exporter in Hong Kong, and because of this event the Hong Kong dollar has strengthened, this means that your goods and services are now more expensive. Which brings me now to the second big story in Hong Kong, and that was that just last week HSBC issued and then modified an outlook downgrade due to concerns of the city's democracy movement as it could sour relations with China and hurt the economy. Now, I'm sure you're all familiar of what's going on a political level within Hong Kong and as I mentioned, the democracy movement. But let's think about what exactly that means for the economy. Solely the economy, of course, there's lots and lots of impacts on a political and indeed on a citizen level. But let's just isolate the effect on the economy for the moment. First of all, the Hong Kong dollar has strengthened, so that makes exports more difficult. Secondly, as I say, in this case, well, not as I say, HSBC say, that this democracy movement could sour relations with China and may hurt the economy because, of course, China would be a massive importer and trade partner of Hong Kong. But the third thing is just to take a look at the graph that I'm showing you now. HK, or Hong Kong, bank lending to mainland China far exceeds GDP. This is telling me that there is a huge amount of lending that Hong Kong has made into the Chinese economy. So this is not just looking at selling goods into the Chinese economy, this is direct lending into China. Now, two things depend or are dependent upon repayability. Number one is, how much of a loan are you giving as a percentage of the entire amount required? And of course what that means is LTV, loan to value. So if I'm borrowing, let's say, 100 units, and let's say that the actual value of the thing that I'm investing is 120 units, well then 20% of that, or 20 out of 120 there, I'm going to have to come up with myself. Now, if instead I'm borrowing 120 units out of those 120 units, well then in that case I'm a far riskier loan. And in general, the Chinese lending only takes place when they provide quite a big down payment. The second thing that you'd have to ask is, how likely is it that that investment would work out? And that is reliant on the underlying element of the economy. Now we'll look at both of those later on, but I wanted, when we look at the Chinese economy, but I want to summarize Hong Kong with three things that are going on. Number one, as I mentioned, the strengthening of the currency. Number two, the democracy movement. And number three, what could happen with China, with its sheer reliance on China, whether it's, as the graph shows you here, lending, whether it is in trade relations, or indeed whether it is in the entire strength of the economy in terms of repayability and economic growth. Now HSBC is not too keen as a result of that, and has pointed to weak residential real estate, to weak earnings momentum due to what I've just pointed out, and potentially a slowdown in mainland tourist arrivals. So Hong Kong is one to watch, as always, as absolutely always. Hong Kong has the potential to really pull it out of the bag, and the fact that the Hong Kong Monetary Authority is there to step in to protect the currency is a very strong measure, but it does certainly need to watch, particularly its reliance upon and the way in which it's dealing with one of its biggest trading partners. So to now really take a look at that specific trading partner, let's now look at the Chinese economy, because it is, and that's why I strategically placed it beside Hong Kong in this webinar as well, is because the two of them are very much linked, but indeed China is linked to several different economies around the APAC region. Now, what I'm showing you here is the composition of GDP. And if you look at the GDP of China, you can see that one thing stands out to me a mile, and that is that peachy colour, and that is the percentage of GDP dedicated to investment. China is trying to do a very difficult thing, and it will take a generation to do, and that is to turn its GDP from investment-led, as you can see there now, to consumption-led, which is the bottom bar. And what you're trying to do there is you're trying to encourage people, individuals and businesses to spend on goods and services, to go out at the weekend and spend in restaurants, to go out and buy HD TVs, to buy more gadgets, to spend on themselves. Now this is a possibility because China has a massively increasing middle class, and that's all to play for, because of course in that case, as you have a rising middle class, you're going to have rising disposable income, and all of that will work out. But as I say, it's going to take a generation to do that. What do you do between now and then? Because if you have an investment-led economy, you need to continue investing in it in order to sustain that. But of course, if you continue to do that, well then you're going to have a crutch in which the economy is going to lie. So, right, let's take a look at China as an overall economy. We are, as I say, the economy is trying to now change to looking at private consumption instead of exports and investments. The economy grew 7.4% in Q1, and Premier Lee said the performance was better without putting a number on it in Q2. Manufacturing grew at its strongest pace this year, but the expansion was weaker than normal. Now, why would manufacturing grow? Well, it's quite simple. Because it has an architecture stimulus in place. The Chinese government put an architecture stimulus in place where they would invest in the economy with a view to creating jobs, and therefore if they're going to invest in architecture, well, then they're going to have to invest in manufacturing to create that architecture. The renminbi has now become uncompetitive, and there is a weakness in exports, and there are declines in housing sales and prices, which drags on construction. Now, of course, if you have got a weakness in housing sales, well then that means that you're also going to have to fill that extra unemployment created, which puts even more pressure on the investment side of the economy. Now, it's important to point out what's going on in property in China, because it accounts for 25% of capital investment and 13% of GDP. If you can add in steel, cement, and construction machinery and materials, this rises to 16% of GDP. Now, household leverage and mortgage loan to values are low, and that's why I pointed that out in the Hong Kong lending slide, because it's important to see, can the Chinese people to which it is lent repay? However, it is facing, and this is China I'm referring to, facing massive oversupply with 20% of an aggregate vacancy rate, and in saying that, direct commercial banks property loans are 1/5 or 20% of banks' assets, and half of those are collateralized in property or land. So this is pointing out two problems. And remember, I am delivering this webinar from Ireland, where we have watched one of the biggest property crashes in our history, and we have looked at one of the biggest falls in employment in Ireland in our history, again due to the sheer amount of people involved in the sector. So if there's one country can watch out for warning signs in property in the economy, believe me, it's an Irish economist. So when I see that there's a huge amount of banks' property loans that they equate to 20% of assets, and I see that of the collateral given for those loans, that it is based on property that may have falling values and certainly are not, you can't rely on them for rental income because you've got a 20% aggregate vacancy rate, this is spelling trouble. And the problem is that this feeds into China's greater problem, which is trying to create a consumption-led economy, because if you haven't got people employed now, or fewer people employed in the property sector, how do you employ them? Well, you have to go back to square one again and invest in more stimulus, which creates your manufacturing, etc. But how then do you create the incentives in order for people to spend on their own VAT? Remember, China has got a national savings ratio of 50%. That's a very, very high ratio. So it has got quite a task in front of it. Nonetheless, you cannot walk away from the fact that the economy grew at 7.4% in Q1 and is on track to pretty much replicate that right across the year. So in general, China does not have a problem in creating economic growth. What China's issue is how it creates that economic growth. And as I say, it will take a generation to do it. For those people investing in China, personally, I have a position in the Chinese economy myself. It is quite, when I say a position, is in the stock market position. It's not showing those levels of growth by any manner of means, but it is showing growth continuously, which I think is quite, cognizant of the way in which the Chinese economy operates. If you invest in it, it does take time. China has got a huge opportunity to offer any investor or any business person, but it is going to have to remember that a credit-driven consumption model doesn't last, and deflation and simultaneous deleveraging make recovery very difficult. But yet, there's a lot of stimulus that can be placed in very good places, as China's railway network is shorter than in the US in the 19th century. So there's lots of bright spots in China, but you have to remember that stimulus will not last forever. Which brings me now on to Singapore. And of course, Singapore is, I have to say, probably the country that I was most concerned about when I spoke about it in the last webinar, because the Singaporean economy at that stage was built on three key cyclical industries. One was luxury and luxury consumption, the second one was real estate, and the third one is financial services. And the reason that I was concerned about it was because if you're dependent on cyclical sectors, unless you have massive money coming into the country, well then it's not going to continue, and then of course that's going to spell trouble later on. Now, unfortunately, I was right in 2 out of 3 of those instances, because in real estate there has been a slowdown of property lending and a cooling of the house market, and domestic loan growth is at 2.3% growth relative to 5.1% the quarter before. And real estate accounts for quite a significant part again of the economy, but again, if we focus on jobs, it's construction is responsible for 4.9%. So if you've got a slowdown of property lending, that is going to follow on and create a slowdown of property building, which may put pressure on the construction sector. Now, financial services is 11.9% of the economy, so a really huge part of the economy, and its growth was down to 3.5% from 26% the quarter before. Now, that's quarter-on-quarter growth, and yes, of course, when you're dealing with year ends, it can deal, when you're dealing with a year end and then you're starting with the next quarter afterwards, which is where that 26% of growth came from. The year end does distort things because of end of year accounts, moving around of rejigging of investment portfolios, etc. Nonetheless, that is a massive fall. So unfortunately, I was right in that regard as well. Now, the third one, luxury, I was wrong. I was wrong on that because non-motor vehicle retail expenditure rose on the back of the pickup of discretionary spending on gadgets, watches and jewellery, and food and beverage services also saw modest gains. So how did that happen? Well, it's actually very, very easy to point out where that happened, and this actually points to both a strength of the current economy but a potential weakness in the future, and that is the unemployment rate in 2013 was 1.9%. That's basically full employment. That means that most people, like the vast majority of people, are employed in Singapore. Now, that unemployment rate rose to 2.1%. Now, of course, all of these statistics are subject to some sort of error. So when you see that it rose from 1.9 to 2.1% in 2014, you're basically saying it's still at full employment, and again, most people are employed. Now, so that means that if I'm an employer, I probably don't have much of a pool to take from. So how do I attract employees? I pay them more. That really is my only option. So then I looked at the inflation of Singapore, and you can see much of what I'm speaking about here in front of you on those statistics from SingStat. The inflation rate, okay, the inflation rate was at 2.4% in 2013, and that rose to about 1% in 2014 so far. Now, what you see in front of you there is that it's up 2.7% in May 2014, but that's just 1 month. Overall, we're looking at about a 1% rise in 2014. So that, that's significant inflation. But here's where the real magic of the economy happens, is that the wage growth rate, so this is the increase in wages, in 2013 grew by 4.3%. So wages grew at double the level of inflation. And secondly, in 2014, so far, wages have grown by 3.2%, which is 3 times the inflation rate so far this year. So is it any wonder that the luxury sector has grown? So, and of course it will continue to grow if we see rates like that. Now that is going to put a lot of pressure on foreign direct investors, a lot of pressure on employers. So that is going to cause trouble. In real estate, you're just looking at, again, possibly oversupply, and on top of that as well, people can only live in one house. And the third thing is, in terms of financial services, well, it was due to jitters, due to shadow banking issues in China, due to the taper in the US, due to issues that are happening in Russia and the Ukraine. So it remains to see what's happening in financial services. That will possibly what happens in the US economy, and particularly China, will have a big bearing on that. So Singapore, it has, the concerns that I had the last time have not been allayed. I can see how the increase in luxury spending has happened. Real estate, as I say, that probably is more so only the start of something that may happen in the future. Financial services is totally exposed to global factors. So Singapore has, in terms of growth of the economy, it has a lot going for it, quite simply because of the way in which wage inflation is happening, but that could point to a total overheating in the economy, and it's certainly something to watch. And finally, now we come to Australia. A place, as I'm sure anybody who has been on this webinar before knows, is very close to my heart, a place that I've been, a place that I have friends, and certainly a place that I'm going to be back to again. But none of that takes from or adds to what's going on in the economy at the moment. Now, Australia, the last time I gave this webinar, was a place that I was saying maybe possibly looking at economic decline. Maybe not economic decline, but certainly not near the levels of growth that it has seen in the past. And of course, I was talking about all of the various different reasons why that might happen. I was talking about the decline in car manufacturing. I was talking about the various different issues that were going on in terms of mining, etc. So what happened? Was I right or was I wrong? And it appears that I was totally wrong, because the Bureau of Statistics announced that there was 3.5% growth last year, and that was the best growth since June 2012 when you look at year-over-year measures. Now that beat expectations. So was I wrong, and was I totally off the mark, and should you just log off now because I don't know what I'm talking about? Well, can I give you a way in which to find out if an economist has the mark of quality? And that is if they find people that have an opposing view and can still defend themselves. Because yes, indeed, this growth happened. But unfortunately, I wasn't that far off the mark at all, because First of all, mining accounted for 80% of that growth. Mining, okay? Now, let's really think about what's going on in mining at the moment. First of all, when you look at all the mines in Queensland, a quarter of them are losing money. When you look at Glencore, which is one of the largest mining companies, a third of all of their mines are now in the red. When you look at new home sales, particularly in mining specific areas, what you need to do is look at places like Western Australia. And when you look at there, multi-unit sales dropped 16% in May, which is telling us that buy-to-let units, the buy-to-let investor is standing back. And on top of that, the most substantial drop in sales was in Western Australia, which dropped by 6.8% month on month. All the signs in the mining sector are pointing to decline, whether it is the fact of their output, which has shown that output has grown, which means the prices will fall. When you look at the profitability of mines, when you look at the sales of houses in certain areas, when you look at the demand of those areas that would be actually buying the goods that mines are producing, mining is on the decline. And therefore, if you're looking at economic growth where mining is accounting for 80% of its growth, and that looks like a sector that could go into decline, then you are pointing to problems in the future. Now, the second thing that I would like to point out is, with this economic growth, it's not just about what's going on at the moment, it's about looking for clues that point out what's going to happen in the future. And there's one thing that bothers me, and what bothers me is there was a 0.6% fall in inventories held by business. Now, Emma mentioned earlier that I have written 3 books. Let's say I am storing a stock of The Savvy Guide to Making More Money, which is my latest one. And let's say that I was anticipating a fall in demand. Well, you know what I'd do? I would sell off my existing stock and I wouldn't be buying in new ones. I would let my inventories fall so that I'm not tying up cash flow, that I have got enough so that I can service a future market, but where I'm not overstocking and I would have to pay for rental or I'd be taking up space in my office, etc. So when you see a fall in business inventory, that is pointing to the fact that businesses are anticipating a lower demand or are already beginning to see it. That bothers me because that is a leading indicator. Now, when I look overall at the economy, as I say, it has the potential to rise. There's no question about that. And you know, Brand Australia are branding us to say that there is a gradual recovery in non-mining. And it's exactly hitting the nail on the head. That's where the recovery needs to take place. It needs to focus on areas like that. Now, it also, you know, Australian property prices in Q1 accelerated to 10.9% year on year, which also causes concern. So it's telling me that the Australian Reserve Bank, it knows what it's doing. It knows where it needs to focus on. It cannot focus on bricks and mortar and on taking things out of the ground and relying on people buying them. It is investing in other areas. But at the same time, inflation is now running at 3%, which is the upper end of the target for the first time in 3 years. And therefore, it now may be caught between a rock and a hard place, because if that is happening, well then it probably will need to increase interest rates at the very time at which some of the other areas of the economy needs that extra stimulus, as I say, like non-mining. So Australia is a place that the leading indicators are not looking good. And to bring this back full circle, the Reserve Bank of Australia, it knows what it has to do, but it is facing a very difficult challenge. But because it's an independent state, it can do what it needs in order to do what it needs to do, whether that would look at fiscal or monetary adjustments. To bring me back to going, I suppose, to finish where I started, and that is, was I totally and utterly wrong to say in the last webinar that economic growth of the levels we had seen for the 22 consecutive years of growth, that potentially that was coming to an end? Was I right in saying that, when it looks like that I was totally proven wrong by 3.5% growth rate from the Bureau of Statistics? Let me finish on this statistic, and that is, if you strip out the terms of trade, the rise in the real national income was just 0.8%. And believe me, that's far less attention grabbing and headline grabbing. The economy really just grew by 0.8%. So therefore, maybe I wasn't that far off the mark after all. And as I say, it's those leading indicators are the very ones that I'm going to be focusing on when we look at APAC Q3. And again, you know, for those areas where I'm pointing out some problems, let's hope I'm wrong. I really, really hope I am. But so far, let's see what will happen, and we'll take each and every one of these countries apart again in a couple of weeks' time. Thank you, Emma.
Thanks so much, Susan. Thank you so much for those very useful insights, and I hope we get to hear back from you very soon in our Q3. So looking forward to speaking to you again, Susan.
Thank you indeed, and I really look forward to working with Morgan McKinley over the coming weeks.